All right, looking forward to it. And hold on one second here. My wife must have just printed something from upstairs, so it's going to be loud here for a second.
That's okay.
There we go. Okay. Yeah, great to be back here with all of you again. Super excited about today. I think the buildup. I was talking to Dennis Gorski about this the other day. I think the buildup has gotten us to a point that next week when we close out, there really will be kind of a cohesive tying a bow on it, if you will, and really kind of Jason alluded to that. Then it's almost like the work begins, right? I mean, it's we need to identify areas to go deeper, but then more importantly, at the end of the day, we could be the most knowledgeable, talented, advisors in the room, but if we don't know how to open up these conversations with our prospects and our clients, then we're left with we're left with just kind of being stuck. I was told a quote one time that really stuck with me, and it was, oftentimes we've heard knowledge is power, and this individual was quick to note that no, that's not it. It's knowledge applied is power. And so ultimately, I recognize that I think it starts with kind of education for things, but then it's, hey, how do we go out there and impact people, make a difference in their lives? So I'm going to do my best to tie all that together and get us down that road, and then we'll figure out where we need to continue from there. All right, so let's go ahead and dive in. Share my first screen here. Boom. All right. So again, the WBC path, we talked about, making sure that every single dollar we save from this point moving forward is earmarked in a way that's going to give us options to create maximum income when we retire. Then last week we looked at, okay, what is this idea of lost opportunity cost? And it is everywhere around us, right? And we looked at the amount of wealth that is going to pass through our personal economies and that of your clients is a tremendous number, regardless of what someone's income might be, right? It's much bigger than what they think. And this idea of kind of plugging the holes in the boat, if we could be strategic with stopping some of these leaks that are happening inside of our personal economy, that in and of itself could perhaps have a much larger impact in the accumulation of wealth rather than chasing a rate of return. And we talked about this idea that there are only two ways to purchase goods today. We either pay cash for something or we go into debt, cash or credit. Both of them by themselves doesn't make one necessarily better than the other. Like it is what it is, right? But I would say that the idea of paying cash for something does perhaps limit the possibility of overextending ourselves and living outside of our means. So we talked about this idea that even as we're going to pay cash for an item, in order to truly afford it, we have to be able to replenish that cash to be able to replicate that expense or that investment again into the future. And I made this statement that Nelson will oftentimes say, Nelson Nash, that we finance everything we buy. And so wrapping our heads around, hey, even if you're paying cash for something, you are giving up the ability to earn interest on those dollars moving forward. And so the most common way of thinking about financing, like some of those buzzwords, come down to interest rates, payments, maybe restrictions, but mainly interest rates and payments. And so it's this idea that if we can just retool our starting point for some of our family expenses, business expenses, or most importantly, opportunities or investments, if we could just reposition our starting point, the type of impact that could have back on our side of the ledger because of a properly designed whole life insurance policy allows us to not break that compound curve of our lifetime that we all only get one, right? So and we went over an exercise of this idea that because we have access to capital on such favorable terms, meaning I don't have to qualify for it, I don't have to ask permission for it, I don't have to lock myself into a payback rate, there's value there. And so we closed with this idea that because that's valuable, when we access that those funds, when we tap into that and we pay our loans back, we should pay it back at a rate that is higher than what the insurance company is charging us. And that was kind of like a mind-blowing thing of like, why on earth would I do that? But we looked at, hey, look, if we double that interest rate or we double that payback rate from, let's say, 5 to 10, it really doesn't have as much of a significance for that total value as we might think. And that overage is then going back to our policy through the form of PUAs and thus growing and compounding even further. So it really is a set of principles that we are executing on. And that's what I think becomes one of the most empowering messages and what clients oftentimes resonate with is the empowerment that they then have over their finances. So that leads us into today. Today, we're going to get a little bit more, I don't want to use the word technical, but kind of, we're going to look at, I referenced 2 minutes ago, a properly structured whole life policy. Brent, what do you mean by that? What is properly? We're going to get into the structure of these for a specific purpose, kind of the why behind it. We are then going to also look at a powerful example. Jawan was talking about all the strategies that could be unlocked through the principles of infinite banking. And I'm going to close with one of those today. But then next week, when we look at a real case that is you're going to see the WBC output, and then you're going to see the power of them using their policy while they were working. It's going to be, I think it's going to be, pretty cool. So with that, let's dive in. And again, unmute yourself, type in the chat, interrupt if you need to. So I want to start us with this idea of properly structuring. Okay. And I also want to dispel some common misconceptions around just infinite banking in its entirety that sometimes I don't agree with. So we're gonna talk about that. But first, I want to come down to human nature. All right. And the way oftentimes people think about insurance. And it doesn't have to be life insurance. It could be car insurance. It could be health insurance. It could be, you name it, XYZ insurance. I think we're wired to have this thought process of biggest bang for our buck. Okay, now what do I mean by that? Let's look at that for a second. And let's just stick in the life insurance world. Let's say that your clients, they were saying, you know what, I need some life insurance, don't know how much, but they go through some sort of an exercise. And let's just say that they feel that they need $500,000 of coverage. Okay, no rhyme or reason, let's just say that that's what it is. All right. I believe that where our first instinct naturally goes is, okay, where can I get that 500,000 of coverage that I want or need for the biggest bang for my buck, for the cheapest expense, the premium, right? So in the life insurance world, this minimum amount down here, this would be term insurance. Okay, term insurance. And let's just say that for that individual, let's say it was going to be $500. Okay, don't get hung up on my numbers, just conceptually with me for a second. Let's say that it's going to be $500. Now, who determines that premium is going to be $500 for that individual? Who sets that? It's the insurance company, right? The insurance company. You go through underwriting and they're going to say, hey, based on, height, weight, male, female, your age, are you a smoker, blah, 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 all these set of underwriting principles or guidelines, they're going to say, here's the corresponding premium that you need to pay. Now, is that premium required? If you want to keep that policy in force, do you have to pay that? And the answer is yes. Okay, this is required. All right. Now, also in the life insurance world, let's just kind of split this into two umbrellas. We've got term insurance and we've got permanent insurance. Okay, I know there are variations of timeframes and different chassis and so on and so forth, but term and permanent. And inside of permanent, since we're going to be looking at whole life insurance with the infinite banking concept, we would say that right here, okay, at this amount, for that same $500,000 of coverage with a whole life policy, okay, that individual may have to pay, let's say, $5,000 of premium for it. Now, again, it was based off of underwriting, right? And so it is the insurance company that is determining how much the client has to pay for that policy. Now, you and I all know, even if you're brand new into this space, when you walk into Best Buy and you're going to go get a new TV and you see two 55-inch TVs next to each other and one is $600 and one is $3,000, you recognize that, oh my gosh, the only way I would pay $2,400 more is I better be getting some other benefits, right? It better be a clearer picture, XYZ, right? So clearly, for someone to go after the whole life policy compared to the term, something entered their mind to where there was a perceived benefit for that same death benefit amount that resonated with them. Okay, I don't want to get into that right now, but we recognize how this works, right? So is that $5,000 a required premium? And yes, it is. Okay, it is required that they pay that. Now, here's where it gets interesting. All right, for that same $500,000, we've talked about the insurance company setting a required amount of premium given the product. Okay, but what oftentimes people don't realize is that there is also a maximum amount of premium that someone can pay for that same $500,000. Okay, and let's just say that for the sake of this example, that maximum amount is $15,000 per year. Okay. Now, here would be the question. If the insurance company determines the minimum amount of premium, the required amount, and they also determine the required amount for whole life insurance, who then determines what the maximum amount is for that same $500,000? And what's awesome is I saw someone take themselves off mute, but if you don't want to say anything, go ahead.
The government.
Bingo. See, here's what's awesome. When you go through this with a client, oftentimes they'll say, well, you, and I kind of laugh and make a joke and say, oh my gosh, I wish it was me. Because if it was me, I'd put a whole heck of a lot more into it. But yeah, it's the government. Okay. It is the government. It is the IRS that sets this maximum amount. This is known as the MEC line, the modified endowment contract. This was introduced in the 1980s for various reasons, but it was determined that the government was saying, hey, wait a minute, we recognize there was massive amounts of funds being taken out of the stock market and getting out of equities and being put into life insurance, and the government was recognizing, hey, it's possible, it seems as though people are purchasing life insurance contracts, permanent life insurance contracts, more so for the tax advantages rather than the intended use of, hey, if I don't make it home to is my family going to be okay, or is my business going to be okay, or the traditional uses of protection. All right, so the IRS comes out and says, wait a minute, we are going to set these limits to identify, is someone using this policy for those issues. All right, so as we look at this and just first talk about human nature, I think it's important for us to realize that we start with this or most of our clients start by saying, okay, where can I pay the least amount of premium in order to get the maximum amount of benefit or coverage, right? Of death benefit in this perspective. Okay, but what we are doing here is we're going to flip that completely on its head. Okay, because what we're after is we're trying to say, okay, where can I pay the maximum amount in order to get the least amount of coverage? Okay, so we're trying to design this policy to be right up below that MEC line without exceeding it. Okay, so let me just pause for a second. Are there any reactions or comments to this? Okay, so Here's what I think is interesting with this. You know, my dad used to tell me, this was before I went and was going to be purchasing one of my first cars. And he says, Brent, do not go in there and tell them what you want your payment to be. He goes, because if you do that, they're going to make it work. They will make it work. You want to go in there and get the best deal, the best price for the vehicle, and let the payment be whatever it's going to be. But if you go in there based on payment, you may not be getting the best deal. And so that always stuck with me, because especially with what I'm about to introduce to you all now, that is completely the opposite of how we're going to have this conversation with the client. Because looking at this graph right here, because we are wanting to structure our policy to be right up under that limit without exceeding it, it really kind of starts with how much. This question is, how much do you want to deposit, Mr. or Mrs. Client? Because from there, and I mean premium, okay, from there, that's where we determine how much of a life insurance policy death benefit do we need to buy in order to get the balance of your premium into that cash value and not create a MEC. All right, so just visually for us to look at this, let's say that was $10,000 per year. That's what they wanted to pay. Then we are essentially saying, okay, how much of that 10,000 needs to go towards the required amount of life insurance premium, okay, which would be, as we just looked, which actually later we'll introduce, is the idea of base premium. Okay, so that it purchases a death benefit that is high enough to allow us to get the additional premium inside the policy, which is done through what is called PUAs, or paid up additions, that we'll look at further. Now, let me go back to the other screen here just for a second. I forgot to write this down. That 15,000, I'll do it right here. That 15,000, this is optional. Okay, so we see the word right here, required. This max line is always optional. Okay, so that would mean that if someone purchased this whole life policy, the insurance company would say, hey, Brent, you need to pay $5,000 a year come hell or high water. Okay, but you have, in my example, but you have the ability to contribute 15,000 per year if you choose to, or anywhere in between. Y'all with me? Okay, so back to this piece. So we have the amount going towards the required side so that we have a death benefit that is large enough to allow us the optional space for the rest of the premium. So as you can see here, guys, like it really starts to be a completely different thought process for the majority of your clients out there, which is why you need to acknowledge that. You need to first understand psychologically that what's going to be going through their mind, so that you don't just, almost even like unintentionally bulldoze them and they missed a major point, right? Okay, let me just check my notes here. All right, so required, base, additional is PUAs. All right, so let's break that down a little bit further yet as well. Here's how I want to look at this. As we continue to go over the structure, okay, this first part is base premium. And I know that on this call, there are varying levels of experience. So I'm going to try to hit everyone on here. But this first one of base, and then the second one is PUA. Okay, let's analyze the difference. When you see or hear base premium, here's what I want to come to your mind. All right. The first one is, with base premium, think of this as long-term. Long-term. This is the long-term portion of the contract. You plan on paying this for a long time. It is the actuarial amount that is driving your death benefit or for the long time. It's going to create phenomenal cash value growth in the long run. Okay, so the opposite of long run is what? Short run. Okay, we'll get there in a second. Okay, but it is the long-term portion of the contract. It is required that you pay it, at least for a period of time. Okay, and we'll explore that as well. But it is required premium outlay. Okay, it is what establishes the death benefit. It is the main driver of the death benefit. Hey, here's the amount that you have based on your height and weight and blah, blah, blah. Base premium, boom, corresponds to how much death benefit that you are buying. Okay. It's also where the majority of the expenses are tied. Expenses of the insurance company making good on their long-term obligations and promises and commitments to you, the end consumer. Commissions are largely paid out of the base premium. And look, guys, by the way, I would say that you don't need to excuse me, you don't need to shy away from that. It's not a big deal. This is level setting, and the client is understanding what's taking place here. So it is where the majority of the expenses are. Okay. Now, PUA, on the other hand, PUA is completely different. PUA, think of it primarily as the short term. It is the short-term liquidity function of the policy. Okay, now you're going to see that there's a long-term component as well, but it is primarily designed for short-term use. Okay, and it's because each one of these PUA, and let me write it up here, paid up addition. Here's what this means. Paid up addition means a one-time payment that corresponds to both death benefit and cash value. Now you're going to see that the primary driver of why we would be allocating PUA into the policy is focused on this component right here. But you're going to see that each contribution also increases in purchases. That's what paid up means. Purchases another set of death benefit. Okay, one time in and of itself. Boom, I put $10,000 in, and based upon my age and health and rating, that $10,000 might buy me $30,000 of death benefit. Okay, it just totally depends. All right, but the driver of this primarily is going to be for the cash value. All right, so it's the short term, increases our death benefit and our cash value. Unlike the base premium that is required, this is optional. Okay, and then the last thing is there are very few expenses tied to PUA. There are still some, right? The insurance company has to still, because they are increasing their death benefit onto the end of the contract and the life of the contract, there are still administrative expenses that need to be tied to it. Now, every single person's situation financially is different, and how we're going to structure the policy and the resources to build it are different. But as a general statement, think of base premium is often a percentage of income. Okay, a percentage of cash flow that's going, whereas PUA could be a totally varying, what's the word I'm looking for? Origination points. It could be a percentage of income. It could be a lump sum of cash. It could be extra interest payments, right? It could be a whole host of things, okay? Interrupt if you have any questions about that. Okay, so now that we recognize that, all right, so the structure of the policy is going to be completely different. I first want to start with how much am I trying to put into this thing? and then recognize I've got this base and I've got this PUA, understand the difference of them both, tying that together, how does that ultimately impact the design of the policy, or even further so, why would I be doing that? When Brent said properly designed whole life policy, what does that mean? Let's look at that now. So let's say that your client was going to pay $10,000 per year for their life insurance needs. Okay. And they really have two options. At least the way that we're going to look at it. Once they've decided that, you know what, I do want this coverage that's going to be there forever. I heard some cool stuff about this whole life. I think I want to put that 10,000 into whole life rather than term. Okay, let's look at first if they were to put all of that 10,000 into base premium. Okay, so on this scale here, here's your 10,000 of base premium. And let's say each one of these notches represents a year. Okay, what's going to happen is in year one, they are going to write a check for their $10,000 of premium, and let's say that buys them, let's say it buys them 500,000 of death benefit. Okay, so they pay $10,000. They have their 500,000 of death benefit, but at the end of the year, they get their statement. They're like, oh, cool. You know, I remember Brent said that, you know, the policy was going to have cash value and all of that. How much is in my cash value? And they look at their statement and they go, oh man, a whopping nothing. That's a kick in the shins. But so they meet with Brent again and we go through it. And I'm like, remember, this base premium stuff is really, really cool. And you wanted this death benefit. Remember, this is for the long term. Just do it again. I'm telling you, just hang in there. So they write that check again. And in year two, they pull up and say, hey, what's my cash value? And it's 0% again. So now they have paid $20,000 and none of that premium went towards their cash. But we meet again, focus on the long term. Yeah, I got it. The end of the third year, now they start to see some cash value show up, right? And it might be that, you know, depending upon carrier, about 75% of that next year's premium showed up in cash. Year three, right? Check for 10,000, boom, there's 7,500 in their cash. And what starts to happen around the fourth to fifth year is the cash value is going to be increasing by more than what I'm paying for in annual premium. Okay, so somewhere around here, it starts to then go 105, 110, 115, right? So on and so forth. Okay. Now, but because of these early years of getting completely whacked from a cash value perspective, generally across the industry and all base contract, the break-even point, meaning from inception to now of how much premium have you paid versus how much cash value do you have in your policy, across the industry, it's anywhere from about 12 to 15 years. Okay, it's just a fact. Now, for someone that is hearing about the idea of infinite banking and, you know, leveraging my money and borrowing the insurance company's money with minus collateral to go put it into an investment or buy a car or whatever it might be, if we told them that, you know, hey, it's going to take 12 to 15 years before you have equivalent in your cash the amount that you've paid in, how excited do you think they're going to be about it? Probably not too excited, right? It might lose some of its luster. Okay. So in comes paid up additions, PUAs. So here is what PUAs look like. Let's say that the client was going to again pay that same $10,000 per year into just paid up additions premium. Okay. The first thing to notice, remember what I said, is think of every dollar that goes into a life insurance contract is premium. Okay. Whether it's base or the insurance company looks at it as premium. Okay. And with premium, comes corresponding death benefit and corresponding cash value. Okay. So the first piece here is because the PUA was done in the short term, this is a singular event, meaning you don't need to make ongoing premium payments for that death benefit. Right out the gate, we could see that $10,000 of premium, let's say, might only buy, let me do it in blue, might only buy $30,000 of death benefit. Okay, so base, it bought 500 because they're required to pay it forever. The PUA only bought 30,000 because it's one and done. Like, it is an actuarial calculation. Boom, you're good. Okay, but I referenced the main reason in these contexts why someone would be doing this is because of that second component, the cash value, right? So here's what happens. If we look at each, let me go back to black. If we look at each one of these as either a year or a singular event, because it could be done throughout the year, whatever it might be, here's how it works. Right when you put that $10,000 into the contract, 95% of it goes to your cash, give or take. Each time you do this, 95% every single time. Now, once that PUA is into your cash value, now it is earning our guaranteed interest as well as the dividend. Okay, now let me just pause for a second. Why is it that only 95% is going and not 100? Well, it's because of what we just went over right here. There are expenses tied to it. There are very little expenses, mainly because you put in 10,000 and the insurance company is increasing your death benefit. There are administrative costs for that. Now, everyone us on the call here, you could choose whether or not, if you want to say that there was a commission to it. We all recognize that, proportionately speaking, our commission rate on PUAs is extremely, extremely low. It is more of an administrative, quote unquote, cost than anything else. Okay, but in any event, we're not shying away from anything. It is what it is. Okay, now the combination of the, let me ask you this, or no, let me do it this way. No, the combination of these two is ultimately what makes this break-even point or this acceleration phase happen. Okay, because a client does not have the ability to just put all of their money into PUA. Like, paid up addition, like additional, means there has to be something that it's addition to, right? Like, there has to be that base policy to then allow us to do this. So back to kind of our graph that we were looking at, how much we want the amount to be a large enough death benefit that allows us to get that total premium in, total being base and PUA, to not exceed that maximum limit. And by structuring it this way, we're accelerating that break-even point from 12 to 15 years to sometimes potentially around 5 years. And all along the way, notice that because percentage-wise, the majority of our annual premium is going into PUA, each year getting to that, we have access to a significant amount of cash. The break-even point might be at year 5 and 6, based upon how much you've put in, but you might have access to more than 50% of your cash getting there. Okay, so it's for the short-term liquidity. Now, if I were to ask you, and think of your clients as well, would you rather put all of your money into PUA or all of your money into base? What do you think they're going to say? I think most of them would look at this and say, oh my gosh, well, PUA. Yeah. Okay, but hold on a second. It's all about perspective. Because what if I just added one little caveat to that question? Would you rather put all of your money into base or PUA when you're 5 years into the contract? Or when you're 10 years into the contract? Because when I look at the scale, I don't know about you guys, but if every single one of my PUA payments always gets whacked at 5% versus every single one of my base premium payments starts to increase every year moving forward, heck, I like that a lot more. And so that's where it comes down to. This idea of properly designed only comes down to, if you want to accelerate the amount of liquid cash you have available to you, then you have to utilize overfunding the contract. You have to utilize the paid up additions portion of the contract. But hear me on this. It doesn't make base premium bad at all. It is what it is. It's designed for the long-term portion of that contract. So I referenced this last time. I can't remember if it was Eric's question or someone else, but we may look at something like this. Let's say that the client was paying, again, $10,000 a year. All right. And when I said that, base and PUA could be part cash or part percentage of income or something else. Let's say that $10,000 a year is just the maximum amount that they could save. All right. Well, then we may do something like this. For the first 5 years, we put $10,000 into the contract. And let's just say that this was a $3,000 base, $7,000 of PUA, 30-70 split, depends on the underwriting amount and so on and so forth. But 5 years from now, because after this, each time I make my base premium payment, go back to the grid here, each time I make my base premium payment, if my cash value is increasing by more that I'm putting in, we call this period here when the policy is quote unquote efficient. What we may do is in year 6, we just strip this down to $3,000, continue paying that forever. And we either take that $7,000 that was going into it and boom, open up policy number 2. Okay, so this is policy number 1. We open up policy number 2, and if the client's situation hasn't changed, they can still only save collectively $10,000. Then boom, we just use the $7,000 of PUA from policy 1, and we go through the same process: maximum amount to PUA, minimum amount to base, and so on and so forth. Now, we don't need to do that just to do that, right? It would come down to, let's say that this client, over those first 5 years, they got into some sort of cash flowing investments, whether it's real estate or something else, and they were going to be loaning that money out. Okay. And the idea of paying back at a higher interest rate, if they needed a tank, if they needed something available to house all of that extra PUA payment, that extra quote unquote interest, then boom, we would need to open up another policy, because this one is tapped out because we structured it to be right at that maximum amount. So we're not going to open policies just to open them, but this is then how you kind of roll through that. At that point, person in policy number 1, they'd be saying, hey, I'm paying an all base contract from this point moving forward. And golly, I love this thing. It's incredible. Increases by a whole heck of a lot more than $3,000 every year. Boom, sign me up. Okay. Last thing before we get into an example here. The next piece is truly really kind of identifying policy structure for folks, right? So I go through, oftentimes after we've done a lot of the education, it's been tailored to them with some sort of an example of how they might use it, whether it's actively, meaning for investments or other opportunities that they're hoping to seek out, or a little bit more, I'll call it passively, just the everyday, or not everyday, but big ticket item expenses in their life. Okay. I think it starts with first identifying, hey, if this makes sense, let's identify the available resources to maximize this thing. Remember, it starts with how much do you want to put in? Let's just identify the available resources. And so here's how I would case prep every single one of this to get the ball rolling. It's 2 areas. It's cash. Whoops. Sorry, it's cash flow, and cash. Okay. So cash flow, very simple. Where are you currently saving money? Okay, well, I'm putting money into my 401k. All right, how much is that? I'm putting money into a brokerage account. Okay, how much is that? And I'm not listing this to say, hey, we're going to throw all of this into the policy. It's just identifying resources that could go into the overall structure. So my cash flow, 401k, brokerage account, I'm making additional mortgage payments. That's a big one sometimes. Okay, whatever it might be. And we add all of that up, and let's just say that that was 20,000. 20,000 per year. Okay, cool. What about on the cash side? Anything initially, when I say cash, doesn't just mean cash sitting in a savings account. If there was there, great. We'd say, okay, money in the savings account, money above the family's comfortable level of cushion, okay? Or it is some sort of an investment. It's in a brokerage account, whatever it might be. There was no rule saying that they couldn't withdraw all that money and put it into a policy if it made sense for them. I'm not talking about qualified funds. I'm talking about non-qualified. But we're just going over all of potential resources, and maybe the answer is zero. Let's look at this two ways. Let's say first that their lump sums of cash, let's say it was zero because they haven't been able to save any money yet. I mean, life's been tough, or they're just getting started, whatever. Okay, cool. The maximum amount of cash flow you have is 20,000 a year. So we're going to structure a policy. I'll show you what the max, what this would look like if you wanted the ability to put $20,000 a year in. And then we go through, and what you'll see on this case study next week is, okay, because of that one and that one and that one, I know that I'm not going to put that amount in. Okay, cool. So what do you want the total amount to be? If it's 15, is it 10, whatever it might be, that is our starting point for then determining the size of the policy from there. Okay, so if there's zero on the cash side, that's how the conversation would look. Okay, these are our only resources, minimum, maximum, let's roll. If there was, let's say, something significant like 200,000 over here for various reasons, whether they just got an inheritance or whatever it might be, then it comes down to, all right, how much of this cash flow ultimately do we feel comfortable committing to on an annual basis? And what we're identifying there is, what's the maximum amount our base premium can be, right? Because although they maybe could do 20 today, if they lost their job tomorrow, or if something happened, it may, based upon the makeup of it, it may not be anywhere near 20. So they say, okay, $10,000 is that maximum amount. Okay, great. Now what we look at is how quickly can we funnel that, in this case, $200,000 into the policy through paid up additions without two things. One, without mecking the contract, and two, without exceeding that maximum of $10,000 base premium that is your comfort level with your cash flow. It really starts to be as simple as this. Okay, now there may be examples and such, like I said, that were tailored to them of, hey, how am I going to use this? Like they have to have a burning desire and see that this is going to impact their family or their business, or whatever, or their risk level. But once that's established, this is where it comes to. So when I say properly designed policy, there is no silver bullet to it. Everyone is different, whether you're going to go 30% base, 60%. Why might someone do, here's kind of a test for knowledge, perhaps. And this is kind of maybe a little bit more advanced, but why might the answer be for someone to go 60% base, which is going to give them a higher death benefit, rather than 30% base right out the gate? Like, what may be the biggest thing for that person to determine that? Any ideas?
If they want to put like a larger amount in the future, like you want to open up the mouth for the policy bigger.
Bingo. It may be that they have plans on utilizing this thing like right away. So they need more available room from day one. So we need to give them a larger tank from day one, whereas someone else that's going to say, hey, I have nothing going on right now, so I'm trying to capitalize. That's another common phrase, capitalize my policy, capitalize my bank. So I want this thing to be as cash rich as possible so that 3, 4, 5 years from now I can start using it. Right? It's just totally different. It doesn't make any one of those better than the other. All right, let's roll into this example because I think this will be cool, and I think it'll leave you with your gears turning, right? I mean, infinite banking, part of that is these examples and how you could use it are not finite. It's infinite. Okay, so here's an example. This is going to be a little numbers driven, but I had a conversation with someone the other day, and oftentimes real estate gets tied into this often. Actually, you know what? Let me do it this. And I do see we have 11 minutes or 10 minutes, so we'll be good. So remember last time when I drew out those stair steps and like the idea of cash, but then lost opportunity cost right there at the top? I'm going to do a big one here. So year 1, year 2, year 3, year 4, year 5. Okay. If this represents someone's policy, if they're putting money into a savings account, is there a load or an administrative fee to just put your money in a savings account? No, right? There's no corresponding death benefit to it, right? So at this point, year 5, let's say all of their contributions might be, $100K or whatever it was. What we're going to look at in this example is, okay, rather than putting that money into the savings account or what have you, what if we're putting it into a very cash-rich designed policy? Because 5 years from now, we know we're going to utilize a lot of this, right? So this red line starts to be our cash value, and it's going to be out of whack a little bit, but I'm just trying to show that the scale of this through these first 5 years, you have less cash than what you would have in your savings account, because remember, there is that corresponding death benefit and the expense. But if our break-even point is around year 5, now what we're analyzing is, okay, what's the difference between this cat that had the money in the savings account and boom, and goes and acquires a property, thus taking his account to 0, or this one that acquires through a policy loan and has the ability to grow from there? That's what we are harnessing. Now, if someone doesn't have this time to build up, then they may say, all right, I'm going to be investing in some deals now because it makes more sense to me, and build up this alternative for the future ones. Or if they've got lump sum cash, we get it in there quicker, the amount that they need for a deal. That's a conversation for a different day. Okay. But let's look at this. Let's say that we are going to, whoops, forgot one of my forms here. Hold on. I know all these off the top of my head, but just to be safe. Okay, let's look at someone that is going to purchase a property, let's say, and we're going to go over this idea of they're going to pay cash for it, or we change that origination point, right? We got that money into a policy first, and I want to just analyze what was the overall impact of that deal for them. Okay, so there are a lot of columns and blanks on here. I'm going to keep this real simple, so don't get hung up on all the other things. I want to go real high level with this. Let's say that it is a $100,000 property. Nope, not a million. $100,000 property. Gosh darn it. $100,000 property, and that's what they paid for it. Okay, so 100,000. Back to those stair steps. They had 100 grand in their account. Boom, they take it out and they buy this property. All right, and let's just give them a couple monthly expenses. I know there'd be more, but let's just look at it this way. Let's say that property taxes was $75 a month. Let's say that insurance was $35 a month. And let's say that they're going to hold this property for 10 years. Okay. So for the months to analyze here, 120. All right. 10 times 12. And let's say that over those 10 years, the property itself was going to appreciate modestly at, let's just say, 2%. Okay. Now, the reason that they're getting into this is for the cash flow, right? So let's say that the rental income was $1,000 a month. All right. So you can see here that $1,000 a month, they pay some income tax bracket. Let me put 33%. Is that what I want? Yes. Okay. So 33% tax bracket. All right. So what you can see over here on the right is their taxable income, $890 a month. Okay. After the 1,000, we've got these deductions here. Then we pay taxes. So it's net $600 a month, $596. And at the end of 10 years, that property would have appreciated to $122,000, 2% every single year. Is everyone with me on that? Okay. Now, people that invest in cash flowing deals like this, as they get that $600 a month in this example, where are they putting that? They are they throwing it into the stock market?
Part of it they saving for like if something goes wrong.
Yes, perfect. Yeah. So these are other conversations to have with the client. Part of it is we need our if something goes wrong with any of these properties, we need to maintain them, so on and so forth. But the rest of it, they're keeping it in liquid cash so they can acquire the next deal. Cash is king to the way these folks are wired. So as that $600 comes through, it's going right back into their savings account or their checking account so that they can build that up and they can go and acquire their next property. So let's look at this for a second. Let's just analyze this piece, okay? And we're going to look at the first method was purchasing the property with cash. And so as we total this, whoops. Okay, so as we look at this, $596 per month was what they were getting net of everything from their cash flow. So times 120 months is $71,520. So $71,520. Their net cash out, meaning what was the property worth at the end of the 10 years? You see it right over here on the other screen here, 122, 120. And then their basis, how much did they have to invest into this property in order to get it? Was 100,000, right? So watch this. Okay, so 100,000. So let's do this math and let's find our overall gain. Okay, so 71,520 of cash flow plus the property was worth 122, 120 at the end. Then we subtract out from it our 100,000 that we put in. So our overall gain in this instance was just over 93,000. Does everyone see that? Okay, so overall gain is 93,640. Okay. Now, what about back to the stair steps? What if we change the origination point to where rather than putting that money just into a savings account, we were capitalizing their policy? And they get to year 5 and they still pay cash. They still go and stroke a check for that property, okay? But they do it by way of loan, all right? So they take a $100,000 policy loan, all right? And now, are they tied into paying X amount per month? No, because remember, they dictate these terms, right? They control it. The insurance company is not going to require them to do anything. So perhaps they say, you know what? I'm a believer in extended mortgage payments and having cash on hand. So I'm going to pay this loan back at, or the insurance company is charging me 4.76%. Okay. But I'm going to pay this back over 30 years. Like that's just how I'm structuring this. I'm still going to get rid of it after 10 years, you're going to see here, but that's what my monthly payback is. Okay. So you can see of that $1,000 a month rent that's coming in, the renters are paying the policy back at $522 per month. Do we all see this? So over here on the right side, look at this. Our net monthly cash flow is $193. Now, I'm not even going to calculate here for a second that would be going into the policy over and above into PUAs. I'm going to say this was just it's going in their savings account, just like the person that paid cash for the property in the front end. Okay. But at the end of 10 years, the property is still worth $122,000. But look at this. They owe $81,000 to their policy loan, right? So if they were to sell that property and pay off their loan, they're only walking away with an addition with $41,000 rather than the $122 on the front end, right? So let's look at this, and hopefully this will be cool and eye-opening. So now our monthly cash flow is less. It's $193 a month because that over $500 payment was going to the policy. All right, so I'll just give you these numbers. That 193 times 120 is 23,160. Okay, the net cash out that we see over here is 41 after we pay off the policy loan, 41,372. So if we just look at this on the surface and we say, all right, well, 23,000 of 160 of cash flow plus the property nets us 41,372, and we then subtract out the 100,000, we're negative 35,000. Why on earth would anyone do this? Someone tell me in 10 seconds, what is the one element we're missing? Think of the stair step. We're missing the cash value. Okay, so with that, the cash value over this time period, future value, where'd she go? Hold on, sorry guys. I need to make it not be, come on. Did it go on one of my other screens? Gosh darn it. All right, so there it is. Okay. There it is. Okay. So 100,000. And let's just grow this. Remember, at this point, the policy is cooking and it's growing at this point year over year on cash value, not rate of return since inception, but from this point, year over year is growing at 4.5% over 10 years. The cash value is 155,297. So now let's go back to the drawing board here. Cash value account 155,297. Now let's total this all up. 23,160 plus 41,372 minus 100,000. But then we have to add back in our cash value 155,297. Boom. Overall gain 119,829, which as we look at this, how much of an overall increase is that? Do it this way. The stupid one always wants to take on top. How much of an increase is that? So from 93,640, they're paying cash method to 119,829. All we did was change the origination point. Looking at that is a 28% increase. A 28% increase in the gain that they have from that one deal just by capitalizing on changing the origination point and taking advantage of dual compounding. Their money is now working for them in the property while it's still growing inside of their policy. Deals like this, if the origination point changes from cash to the policy loan, will increase the rate of return on anything out there because of your money working in multiple places. And with that, we're going to end today. And next week, we're going to tie all this back together with a case study, but hopefully this one example, after we get through structure and the why behind it, lost opportunity cost, everything, and then one example of the idea of the money working in two areas and increasing by 28%, hopefully that starts to get your gears turning of the powers that infinitely apply here. Thank you all. Jason.
Yeah, thanks so much, Brent. Hey, one detail question. We've been admiring your software tools each week. What was that real estate software tool title that you were just using in this scenario?
Yeah, so that is called Truth Concepts.
Truth Concepts.
Yep. So www.truthconcepts.com. It's a whole, every single calculator that you've seen me use with that is part of that calculator package. Yep.
Excellent. Thank you for sharing that. Well done. Want to encourage everybody to go back and catch that last 10 minutes. I'm sure your brain is a little swollen. Go back and catch it. It's there. It'll be on the recording. That'll be out in a couple days. But let's just close it up quickly and easily today. Thank you, Brent. We'll see everybody back next week, same time, same place. And thanks for being here.
Thanks, y'all. See ya.
Bye-bye.
Nice.